Hello, warriors. Welcome, viewers from investing.com. What a wild December. It's like Santa Claus should be pulled over for a DUI. So, big story, of course, has been this recent two-day drop. Has almost negated the two-day rally from Powell, G20, even though the Chinese have said that there is a deal. This was part of the doubting of the deal. So I don't know if we're just going to wash out to new lows, finally clean out these lows, maybe even the January lows last year. I mean, that's where I think the bears are gunning for it. But I want to talk about something that we don't talk about. You know, a lot of people have been rooting for a bear market for a long time. You know, it was silly how it was going up on easy money. But I want you to take into consideration its impact on the economy. First of all, we have the Fed raising rates. They're also reducing their balance sheet. And if this continues, it has already wiped out massive amounts of money. I don't know if it's trillions of market cap. And to me, that's a tightening as well, because those funds or that amount, even if it was on paper, could have been liquidated and deployed and spent by, say, the consumer, and is the currency of each individual company is their stock. So their currency is depreciating in value, gives them less flexibility to invest, even though when times were good and their stock was soaring, they went with buybacks and corporate borrowing. Can you imagine the pressure on them now with rates going up? They bought back their stock, and it costs them more to roll over their corporate debt on now not an appreciating asset, but a depreciating asset. Anyway, so I'm cheering no matter what happens here, how far this washout goes, or we hold it in here for another rally. And in fact, I have a super bear as my guest today, Peter Temple. So it's for mature audiences only, not for people that only want to hear Pollyanna stuff. And, there are things that I wish I didn't know, and I could have my head in the sand about what I see as a possibility down the road, but better prepared and scared than naive is what I say. You guys agree with me? Better to be prepared, even though you're scared. So, okay, let's get to the market, because, it is quite surprising with all this equity volatility, how there's basically none in the dollar. Okay, now I believe part of a recovery in the stock market is going to come with a weakening dollar. The question is there one more breakout? I'm not an Elliotician, but maybe this whole thing here is a 4, and we get a terminal thrust over 97.5 to mark the top into the end of the year. I think that's possible. One of the reasons is you would think that with S&Ps down 60, that we would have had a lot more weakness in the yen. So, I mean, even if you sold the rally good at 1320, I mean, why aren't we down here? The market's taking it out. So there are some signs that flight to quality could be ending. I think Andre talked about 282 on the 10-year, and I don't think we're that far away. So I pay attention to Andre's harmonics. If you're not a subscriber, you can do so too. So he's looking for one more day as a target. We are beginning to diverge a bit here. So 282 is only 7 more basis points. So we could be within, we have NFP tomorrow, maybe 2-3 days of what could be at least a temporary bottom. And some people are thinking a more important bottom. So we'll see about that in equities. The gold, really not making much hay, but I still think, especially once the dollar turns, that the gold should have a chance to break out and take it up towards 1260, 1280. The silver gold ratio is coming back in because gold basically unchanged, while silver from Tuesday has come off quite a bit, 30 cents. So silver now acting a bit weaker, under 14, under these lows, this moving average, it could be very vulnerable again. And of course, when we wrap it with Bitcoin, you look at the daily, and what I teach in relative strength is this is no bottom, okay? Because look at these RSI readings, 10, okay? So now we're up to 33. The next low will diverge. I don't believe it's going to confirm. Not sure of levels. I know a lot of people are talking 2,500 for a while. I may even take a shot down there with an ETF. Should we wash out there and the RSI structure begins to improve a bit. And I think that's pretty much a wrap for me. So stick around for Peter Temple at the top of the hour. And I think you're going to get some great counts. We're going to be talking about our wheelhouse, which is currency. And I believe it was also last Thursday, because, I like to show some ETFs because I know our audience in on investing.com have probably more of a slant towards ETFs. So Nugget trying to turn good too, showed it down here last week. No trip to Hollywood, but we start closing back over this 14 level. We could head higher. My preferred scenario would be that Nugget and GDX, which is the blue chips, have one more wave down to new lows. I've seen I do a lot of intelligence gathering, and there's a lot of talk about a 16 reading on the GDX. Also, a lot of psycho guys were looking for a bottom in gold into the end of the year. So the action so far is inverting that cycle, but it's still only the 6th of December. And as you see how S&Ps can move as we continue into the end of the year, volume continues to dry up, and while the cat's away, the mice will play. Those algos are going to play, and actually their trading has even more impact during thin market conditions. So great to be back with everyone. I just want to say that it's definitely worth a shot to spend a buck and immerse yourself. I would say that it's a very good value because you get five forms of analysis and methodology for the price of one. You get Elliott from Grega, you get harmonics from Andre, you get basic technical from Blake, and candlestick from Steve Volke, and macro from Stelios, and not just what you hear here in the webinar. So take a trial for a buck and immerse yourself in it. And the other huge advantage is the chat room, because FACE is a free webinar, right? I always say surround yourself with traders that are better than you. There's lots of them in here that are better than me. And you could do your intelligence gathering. Hello, Amanda. Amanda's been in the zone, lives in the UK, and been playing the short side. She runs the chat, playing the short side of cable. See? So you get this type of interaction. Also, a lot of people love to hang with Blake. Look at that guy. There's Blake. And, he's there all day. Steve Volge's there all day. Grega drops in. Joe is in there. Joe's a CMT. And, this is a huge advantage. So outside the FACE community, you have the ForexAnalytix community, which is, become part of our trading family, and take advantage of surrounding yourself with great ideas every day. So There's Blake. Yeah, he's got his shades on, and it's still dark outside in Scottsdale. All right, so I'm going to turn it over to Blake now. Tomorrow we have NFP. So, prune positions, that's my philosophy, is to not predict a binary event like the NFP, but be flat into it and have all your zones pre-planned before the release and then react to the reaction. So good hunting, everybody. I'll be back at the top of the hour with Peter Temple. You're going to want to see this. We're going to be covering the dollar, the euro, Aussie, gold, and most likely the S&Ps. So should be a great interview. Hi, Blake. How are you, buddy?
I'm doing okay. How are you?
Okay, buddy.
Good morning, Dale, and good morning, everyone. Especially those of you that are tuning in from the investing.com community. I hate to start off the webinar with on a downbeat, but in the ForexAnalytix community, we lost a really important member of our community on the 28th of November, and we got the news from his wife yesterday. Anyway, for those of you that don't remember Captain Ron, I'm putting his YouTube video that Dale did an interview with him a while back. I guess it was, it was back in April of this year. He was diagnosed with stage 4 cancer and passed. And I have to mention that he has been a big staple in our community, in our chat rooms. As Dale was just showing in the chat room, he'd been in there for, well, I've had him in my chat rooms for about 4 or 5 years now. So he has just been he's a great individual, and
he loved the community, Blake. I could tell by that interview, and he was telling people, God, I remember him saying, you should join. You're going to get your money back by the, he really was a fan of your work.
He's one of, there's been a few people that I've come across over my years with the ForexAnalytix community that have been, and previously the Wise Trade community, that have always been willing to help. And he is one of those people. So,
we miss him.
We will. Anyway, I'm going to take away the chat room here and
okay, buddy,
and get into the charts, because we do have ADP non-farm that is coming up right now. It'll be here in just a minute, and we'll just keep an eye on the dollar index. Now the market's looking for 195,000. This is the Bloomberg terminal, so you'll be able to see the data as it's being released.
This number is gaining more importance, almost as important as NFPs now, Blake. Have you noticed that?
It is. It takes a lot of the weighting away from NFP, but NFP from the BLS is still really important. This is the private sector jobs, obviously. One thing about let me just really quickly just look at the dollar. I mean, we are range bound in this triangle. I think we're going to stay in this triangle at least going into today, despite the news that came out overnight. I mean, all the moves that we saw were really in the yen pairs, which I'll talk about here in a few minutes. But we have to let's see, how much time do we got? We've got about 40 seconds. So you're going to see this the Bloomberg terminal. You'll see it pop up here before you see it anywhere else. So just stand by. And the jobs numbers just in general are starting to gain a little bit more attention, because as we are in quote unquote full employment, we are in a situation where if we stop creating 200,000 jobs a month, it's going to start to impact the dollar in a negative fashion, as we've been in a really strong job creation environment for quite some time. The numbers are out, 179,000. It is a miss. So you'll see the dollar probably under a little bit of pressure here, not too much against the dollar index. The dollar yen hasn't it's moving just a hair, but not a whole lot. The euro dollar is probably going to spike to highs here and break above the 60. It's going to trip these top stops above these highs, I'm assuming. 618 retracement comes in at 113.70. Hold on, let me go ahead and clear out my out US dollar Norwegian krona short ad from earlier. I just exited my US dollar Norwegian krona. I'd shorted a little bit earlier this morning up here at 55, and I just cleared that out. I'm keeping a core short, but I just I have been adding. I added this morning. So the euro is just kind of probing some resistance here. Not too exciting, but we might head up towards, this is the 50% retracement. We might head up towards the 618, which is 113.75. I wouldn't expect too much out of this. I mean, we are range bound. You know, bottom line is don't expect too much. 114, even if it starts to run off a little bit, 114 should cap the rallies here. And let me see if there's, hold on really quick. I just double check some things. Yeah, so anyway, it again, a little weaker number, and this the reason why this is starting to impact data, impact the market, and watch ISM too, because we have some really strong headwinds that are working against the market. We have somewhat benign inflation. Okay, we have prices that are starting to go up slightly, but we have tariffs that are starting to bite. So you got a situation where you could have a little bit higher inflation, weaker growth, and then that's gonna stop the hiring of new employees for most employers. And so that's the risk moving forward for these jobs numbers, is they're going to start to, you might start to see some job losses coming in the next couple quarters for the U.S. And so that's why these numbers that came in at wherever we came in at 176,000 or whatever, 79,000, it's going to start to show a little bit of signs of weakness. And I think that's going to be a little bit of a, pain for the U.S. dollar moving forward. So just keep that in mind. So the euro is probing up against its highs. The cable, I don't want to get too excited about the pound while we're below this 128.50, 128.40 level. We have a downtrend line that's pretty important. It comes in around 128. So this resistance here is probably going to be pretty important now. And remember, next week is the big week for the for the cable. The Aussie just beat down, but we hit the 50% retracement, probed through some of these lows. If you use ForexAnalytix, you can see that you got updated on the Aussie dollar a little earlier, as we found support at the 50% retracement, probed some stops below there. You already got that chart, so you can see how it's starting to lift a little bit. And this is, you look at what happened with the Aussie. I mean, we're from 74 cents to 72 cents. We've lost 200 pips after the great news over the weekend with China. I mean, obviously the news came overnight with the Huawei CFO being arrested in Canada on behalf of U.S. And this is a situation where it's like a corporate hostage, if you will, and as the CFO is being used as a chess piece in this trade war. So you got to be a little careful here with the Aussie and China situation. Obviously, we could see a bounce here, but I don't know how sustainable it's going to be. And this has caught a lot of people off guard. You look at the S&P and how we gapped last night. It was pretty crazy. Now you were talking about the S&P. I'm still looking at this big long-term trend line that comes in. It comes in right here, basically where we're at. You know, below 2640 in the S&P, things get a little scary. But for right now, hold on really quick.
Get
What's that?
get
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 what?
scary.
Oh, things that could get scary. Yeah, if we get
I
below.
think they. When I looked at the opening last night, it was scary.
Oh yeah, I mean,
It's already scary.
it crushed a lot of people. You know, a lot of
All
people,
that
especially
market cap, Blake. You
if
come
you're
from the
playing off that
equity.
618 here.
Yeah.
You know, uh, uh, if you're playing off that 618, you know, and thinking, oh, you know, everything's good as the U.S. is closed, and then all of a sudden we gap through there. I mean, it was an ugly move, really
Yeah.
ugly move.
A lot of
So
market cap has disappeared.
yeah, yep, a
That's
lot.
wealth that could
But
be
you know,
deployed in something.
you look at the daily chart in the S&P. This is where it gets really ugly.
Right.
It does. You know, the ones, and if we heaven forbid we break 2600 and this market's going to hell in a handbasket and Santa Claus is not coming to town this year. You know, for a lot of people,
It'll be on a milk carton.
he might be. Yeah, he might be. And so it's a scary. I mean, this is a scary looking, you know, scary looking move all the way around. It is. Now, the yen, and one of the things you should be watching for with the yen is, you know, it's testing this year-long trend line here, right?
Yeah.
So that year-long trend line is being tested, and you talked about. I don't know if you talked about it, but I'll tell
That
you,
it should have been weaker with what's been happening with risk off and yields falling.
Yeah, and so this spike up in the dollar yen caught a lot of people that were short
What
that
was
were
it?
expecting this. I don't know. I'm not
Yeah.
sure what had caused that spike, but I know for a fact some people got caught in that because
Yeah.
I know a guy that got caught in that. He's like, you know, I was shorting into that trend line thinking, okay, this is we're going to break, and then, you know.
Right.
Wham, you know, and he's one of the same guys that pointed out that we were at this trend line over here, and just one of the traders that I talk, not in our chat room, that I talk with from the office. He's like, you know, I was shorting into that thinking, man, we're going to break, and then, you know, it went whoop, you know, right up.
I've never seen a more treacherous December.
It's extremely treacherous. It really is.
And I'm old, right, Blake? So I've seen a lot of December.
You are. You ain't no spring chicken, Dale. You are not. So if you look at the euro yen, also the euro yen bounced off of triangle support as well. You know, so this is one of the things that, you know, if you look at the euro yen, this is a little concerning when if you're short the euro, thinking about one of the biggest cross rates that's going to affect the euro dollar the most. You got the euro yen. You know, euro yen's, you know, bouncing off that support. So, you know, just again, food for thought here. Aussie yen, right? Look at this. This is crazy. This is so. And this is I'll tell you right now where the Aussie yen goes. You know, tits up is right through here. You know, we break 81 in the Aussie yen, and that thing's done. Stick a fork in it.
What will it end up? What position will it be in?
Tits up.
Yeah,
sorry,
that's okay. Sorry. You know, we're real here. Okay.
So, hey, you know, sorry if I offended anybody. I mean, you know, it's on your back.
There you go.
I have my man tits up. How about that? Does that sound fine?
Yeah.
All right. That sound better? All right. Yeah. I'm a little bit more PC for you guys.
I have my man zero on.
Okay, so the Kiwi yen's back below the breakout point here, and hold on, it's at the fib level I wanted. You can see it also held the 618. Canadian yen looks pretty bearish. We broke through that, and now this is daily trendline support that comes into play right here for the Canadian yen. So you can see all these yen pairs. I mean, you know, how important are we? Look, I'll just throw it out here. I wouldn't want to be short now, but in the event the S&P breaks down, you have really a lot of yen pairs that are really could really open up to the downside. Canadian yen,
Yeah,
Aussie
so it
yen.
looks like the line in the sand to me, Blake, and yeah, we do have NFP tomorrow, is
Yeah.
60. If we take out last night's lows, it's going to look, and that's your major trend line. So that's kind of the line in the sand
Yeah, it is,
on the
and
yen.
that's the when you talk about a line in the sand, and this is I do this all the time, and that's why we put it on Forex
It's an
Analytics.
Obama line in the sand.
Well, we call it the bull bear line, and
Okay,
the
that
bull bear
that
line is
is.
really where you're a bullish above, you're bearish below, or you can call it your line in the sand. It's and those are phrases that I've used for my entire career. It's like, okay, as long as we're above this level, I'm bullish. We're below this level, I turn bearish. I mean, it's pretty simple. And now, does that mean that I need to, like I look at the line in the sand in the S&P and I say, okay, it's right here at 2640. Does that mean I need to be bullish right now? No, but if I'm looking from a risk reward perspective, it makes sense to be a buyer down here. Then you have to take in like the macro reasons why you want to be long or short, and so I look at it and go, I don't know if I really want to be long, but I know that the market is not super worried while we're above that level. We get below it and then things change. It's the what could really change the dynamics of the entire market. Another currency that we should be watching is the US dollar Canadian. I mean, the US dollar Canadian is probing above this resistance here. In the event risk continues to improve, the dollar Canadian may fail and break back below this resistance or this support. This is going to be really important going into tomorrow because, if things reverse and we close back below 133.80, then the dollar Canadian becomes pretty bearish, in my view. All right, so it's bullish right now, but and then we have Canadian jobs data tomorrow. So, if U.S. is weak, Canadian data is strong, and it does this, like that, then we have a complete reversal happening. But that's going to be on my radar really for tomorrow. I think that we're at such an inflection point in the U.S. dollar Canadian that's my pair of choice. If it's weak U.S. data, strong Canadian data, I'm probably going to look to short the dollar Canadian. And if it's strong U.S. data, weak Canadian data, then you gotta target wait, we're talking levels that could go quite substantial actually if it really continues to break out. There's a lot of open air that takes us all the way through the high 130s, 136, 138. So this is the pair. I'm not necessarily trading today, but this will be on my radar going into tomorrow for sure. Because you have it's either a breakout or a failed breakout, and if it's a failed breakout, it will be more powerful to me to have weak U.S. data, strong Canadian dollar. That'd be a better trade from a intraday movement standpoint, but I don't know if that's necessarily going to be the case. And with that being said, oh shoot, wait, hold on. We have Canadian trade balance happening right now. I might as well stick around for it. I'm not really doing anything till ISM. We have ISM services, and we have Pullas is speaking today too. So Canadian trade balance coming out. Let's go ahead and grab the Bloomberg terminal, and then I'm going to give it to Stelios and Steve.
You've forgotten our names already.
I did. I totally forgot. All right, so here's the we have some other data too, so you can see it all.
Constantinos, who was arrested? She was arrested same day as the meeting.
The Huawei CFO, right?
That's what they're saying. I don't know why we just trade balance came in line. Initial jobless claims are going up a little bit. See, this is a little bit of a risk for the dollar. I think the jobs picture is going to be a risk moving forward. You're going to see employers really paring back, and there's a lot. I feel like I'm the only dollar bear in our chat room. Everybody else seems to be a dollar bull at this point. I'm actually a dollar bear, and even though unless the stock market completely goes south, which is a risk. I mean, if the S&P starts breaking through 2,600, then then we have a situation where it's more of a liquidity issue, and stocks really turn south. But as long as equities continue to hold here, I'm more of a dollar bear than bull, and I'm more worried that the U.S. economy is going to start to show a significant slowdown moving forward.
GM laying off, everyone laying off, a lot of layoffs coming.
A lot of layoffs and a lot of hesitation because of these tariffs and the China, U.S. and European trade tensions. I mean, you look at what's happening with GM because of we're going to be. We got Tariff Man, we got Rocket Man, we got Tariff Man. He even self-proclaimed call himself Tariff Man. So now we got Tariff Man going to town on European autos, and so much.
It's interesting. It's interesting, Blake, that a Republican president, because the Republican Party has always been
free traders
against taxes, right? It's interesting. It's interesting that the Republican president calls himself happily tariff man, when what the tariff is in essence a sales tax to the local consumer, because the tariffs are not being paid by the Chinese or whoever else is selling goods to the US. It's being paid by American consumers.
Larry Kudlow for years, his spokesman, has been a free trader, no tariffs, no taxes, and here he is supporting this trade war. It's unbelievable.
Just so you guys know, my wife had to get some supplies, and she had a shipment come in from China, and what was a $20,000
inventory.
A purchase price ended up being closer to $30,000 after tariffs. That's
a big increase.
If you're a small business, that number automatically, it's absorbed by the corporation or the company, but that company has to pass that along
to the consumer.
Or the margins are too thin, so it eventually will trickle down to the consumer. So the companies absorb it as they can, but eventually it's going to make its way to the consumer, in higher prices. So,
Blake, your position on the dollar, I think that the dollar needs to break to save the market. And I believe that whether it's a Fed or the Treasury, whoever, will sacrifice the dollar for the cause of a recovery in equities, because it's their tax revenue machine.
Yeah, well, we'll see. We will see. Yeah. Well, good morning, Steve Stelios. I'm going to turn it over to you guys, and I want to thank everybody for being part of our community. And if you haven't had a chance to watch the Face interview with Captain Ron, you're going to get a lot out of it. He was a really great trader. I watched him for 4 or 5 years slay the markets, and really is one of those people that took the time to help people in need. He's very similar to our man Amir Dulashahi that's in our chat room now, that had always been the person that would take care of other traders, and we'll miss him dearly, and we'll all be eventually making down to the British Virgin Islands, to the soggy dollar, to have a beer with him, and I'll eventually make my way there myself, and to have a beer in his behalf. So thanks everybody for being with me, and I'm going to turn it over to my colleagues, and I'm sure they'll talk about our partners and our sponsors Forest Park FX. So thanks.
Thank you, Blake.
Thank you,
See you,
Blake.
Blake.
Steve,
Hi, Steve.
before we start,
Hey,
just I
Coach.
just wanted to put to give my 2 cents regarding equities because they seem to be the focal point these days. So people who have been listening to this webinar, they've heard me talk about it before. But my view on equities had quite a big shift a few months ago. If we go back to 2008, 2009, the big crisis, obviously all equity indices, most equity indices crashed. The S&P went from 1600 to 666, I think it was, wasn't it? Anyway,
67, yeah, something like that.
67, whatever, yeah. But after that, obviously, there came a time where equities recovered because it was a big drop. All the central banks came in, cut rates to zero, quantitative easing. That all helped. And we had a few years of expansion that made sense. But then, ever since, 2013, 2014, we seem to be going higher. No, I don't want to say purely on the fact, but really mainly because we had zero rates, risk was encouraged, it was easy to borrow, corporates were issuing bonds and using the proceeds to do buybacks. This is not the sign of a healthy market, but still it went up for a few more years. There was big gains. But then, in my opinion, the technical event that happened, which I think is the trigger for what's happening, is that we had the 10-year yield in the US breaking out of a 30-year channel. I mean, that was a huge descending channel, broke out in August, I think, of this year. And when that happened, and it looked like, okay, granted, treasuries are rallying a little bit now, but they're still outside the channel. When that happened, my view shifted straight away. My macro bias shifted to bearish for both the S&P and the DAX, actually.
You have that chart still?
I do have it. Yeah, hold on. Let me share.
Why don't you show it to everybody? That's a big deal.
Let me take the screen. Hold on a second. Change presenter.
Mr. Macro.
Organizer.
Coach, you remember that we were talking about the possibility of this double topping yields, right? And you see what happened. We just gapped below the 200 DMA like it was never there, huh?
Yeah. And Andre was talking 282 last week when he was on.
Yeah, the target here is back down roughly at 280. So,
we're almost there. We're a day away.
Yeah, if we keep moving like this.
Yeah.
So as I said, in my opinion, that changed in August or September. When was it? The S&P was around 2,800 or a bit above, actually. And I was saying at the time, look, I think things have changed. We've gone away from the buy the dip mode, and this is going to be the other way around. Any rallies are going to be sold, in my opinion. And also, we've talked about this with Steve quite a few times. The market has been conditioned for years to buy the dip. You buy the dip, you make money. Well, this thing eventually is going to fail, and it seems to be failing. And when that happens, the sell-off is going to be a little bit more pronounced. So my opinion is, and I'm backing that up with my personal portfolio. We're only like 5% of the portfolio in equities, so we really almost have no equities now. And I think that my target for the S&P. Where's my chart? Hold on. Somewhere in the bottom end of this channel, somewhere around 2,300 is where I'm really going to start looking at it to go on the long side. I mean, could it go with much lower? Of course it could, but I think, and I've said this before, I think that because people know what the central banks can do when they need to do it, all zero rates, QE to infinity, I think the next downturn in equities is not going to be as pronounced as it was in 2008. It could well be, I've been wrong many times in the past, but I think people know what the central banks can do now, and they're going to step in. I mean, we should have no doubt about that. They're going to step in when the time comes, and they're going to be ultra dovish. They're going to restart QE. They're going to do whatever it takes, like Draghi said, to support the equity markets, and we've seen them do it. We've seen them every time there's some kind of meaningful dip. The little voices, they come out, they start issuing statements trying to control the market. So that's my view on equities. I'm still bearish in equities overall. The European equities as well.
The thing, Stelio, is the following. I wrote earlier in the chat room that everybody in the market was talking about two possible events the last few weeks. One of them is that would be bullish for the markets. One of them was Fed becoming more dovish. The second one was the U.S.-Chinese trade war, subsidizing a little bit, or calming down or whatever. So we got both of those happening. I mean, there was clearly a shift of stance from the Fed. I mean, within like a month, they shifted the goalposts while they were in essence pointing to something roughly like 3.5% being the current neutral rate. They shifted that to something. They're not saying exactly, but they make it sound like we're maximum, let's say 0.5% away from that. So
yeah,
they
2 more hikes,
down.
December and then 1 more.
Yeah, so they moved it down, let's say, to 2.5% roughly. And at the same time, we got like good news that there is goodwill that within the next 90 days, Trump and Xi will negotiate like some kind of a deal. So the tariffs, they don't get increased to 25% in the start of January, etc. And what happens afterwards? The market starts after one more day of hurrah. The market starts plummeting down. So how do you call a market that sells off on good news?
Yeah, and how much more dovish can the Fed get? December hike is happening. There's no way they're gonna not do that, not deliver that, and then we're pricing 1 more, and then that's it. So how much more dovish? Okay, we take away that hike.
If you remember, I'm not sure if you were here because I know that you have to leave sometimes to pick up the girls, etc. But when we had that interview with how is coach? How is the guy called? The one that we were speaking the other day with, the one that's also like bearish. The S&P, and we had multiple conversations. The name is escaping me now.
Anyway, it doesn't matter. It's okay.
I remember that I said I'm a little bit skeptical about something. He also thought that we might have one more high, and we still might, but based on the fact that the Fed might turn a lot dovish. But I'm starting to wonder. Isn't there a chance that just everybody's going to panic the moment they realize that the Fed has no escape plan? Because the Fed so far could actually make a case that we've had a successful monetary policy. We saved the economy in 2008, and we have an exit plan. I remember very clearly when Bernanke was interviewed and saying, "Isn't what you're doing like debt monetization?" He said, no, this is not debt monetization because we intend to increase our balance sheet, temporarily, and then we're going to unwind it. And so in essence, we're not doing debt monetization because we don't intend to keep an inflated balance sheet. But what happens once the market realizes that there is no exit plan and the balance sheet is never going to go down because in essence they've unwinded like 1, 2, 3%, whatever they've done, and then they might be forced to start another round of QE. So what happens then? Why is it necessary that the market is going to trust that another round of quantitative easing is going to have the intended results? Because if the past is a guide, we had the first big bubble in 2001, in 2000, actually bursting in 2000, and then we created another bubble, and then the second bubble needed a lot more drugs, let's say, to get the patient back in not having a hangover. And this time around, we've inflated another bubble, and I don't know if the patient can actually survive, the amount of drugs that is needed to get him back from the, hangover. So personally, I'm not that optimistic. I think that the only way that once we confirm that there is a downtrend, that there is a bearish market that has started, because it's not confirmed yet, I'm afraid that the only thing that can help the US market somewhat survive, in a much better way than it did in 2008 is by having the dollar getting destroyed in the process. So in essence, getting a smaller depreciation in stocks, but only from a nominal standpoint, not from a real, price standpoint. That's what I think.
I personally have no doubt that they're gonna, when the time comes, they're gonna come in. They're gonna do whatever it takes. So I think the result is going to be depreciation of the dollar. The Fed's balance sheet will continue to grow. The federal debt will continue to grow as it has done over the past few years. And they see that this formula works, and I don't think they're going to hesitate for a second to do it again.
Are they still going to go ahead with a tightening this month, guys? What do you think?
Yeah, I don't think they're gonna surprise them. I mean, it's fully priced in, so they don't want to surprise the market.
Me too. Sure. I think that because it's fully priced in, they're not gonna make an attempt to do something different.
Okay.
Celio, sorry.
Did you take the screen?
I took the screen off. So yeah.
Okay. So let me grab the screen myself.
Yes.
Yeah. So we spoke yesterday. Actually, we had Grega yesterday. So whoever wasn't here, it's very interesting to go ahead and have a look at yesterday's interview. But while Grega was here, I also gave my point of view on a few things, and one of them was the fact that this is a descending triangle in the DAX, and we're breaking lower. If you remember, I kept saying that. And yesterday, I also mentioned that the FTSE was testing the this triangle, which, as expected, got resolved to the downside. Keep in mind that the FTSE is now trading at lows that we haven't seen since December 2016, right? So the FTSE is already trading at a 2-year low. That's something to consider. And keep in mind that that is happening at the same time that we've had on average, we've had a strongly depreciating pound during those 2 years, right? So the pound has been acting as a tailwind. So imagine if the pound was stable or the pound was appreciating, where the FTSE would be at the moment.
How's the EM held up, Steve, during this rout this week? Because you had that minor breakout in EM.
Listen, first of all, if you remember, we called the top here in the Nikkei literally. I mean, I said that, listen, be very, very careful what you're going to do here, especially with the yen, because it seems to me that the Nikkei is going to get, rejected once again as it did here. This time it never touched the trend line, the broken trend line support as resistance, but it came very, very close. And look where the Nikkei is currently, coach. So I doubt it that the yen can hold up much longer in this contracting range, especially once the Nikkei also confirms that this was one leg down. This was like a simple ABC, as you see here. So there is at least one more leg down, and it seems that it's coming with some force, with some momentum. So what the yen is doing is, as you see, more or less nothing. That's why I also wrote to the chat room, and I've also said it on the webinar. I think I repeated the same thing yesterday to Grega, that I find the yen extremely tedious, and I have no reason why somebody would want to tie up their capital in the yen. Look at it. I mean, it's doing nothing in comparison to everything that it's correlated with, because
all the currencies are dead, except for maybe Canada.
Nah, commodity currencies. The Aussie is suffering heavily today.
Yeah. Okay,
not only today, yesterday as well. And the Aussie is in a very big risk of breaking down here, because it was appreciating within this channel. Today we seem to be breaking below this channel, so the Aussie is also suffering. The Canadian is also suffering. You're right, on the other hand, that most of the
majors.
of the majors, of the lower volatility currencies, are not doing much. But the case with the yen is that, what is the yen notorious of being correlated with?
Yields.
And risk.
And risk.
So what do we have? We have yields breaking down. I mean, I showed you that huge gap down that we had. I mean, this is a major technical event here in the yields. Here it is. a double top being confirmed by the break below this range, and boom. Now, what is happening with risk? Risk is
Looks like
breaking.
Facebook, Apple.
Yeah, risk is risk is breaking. Whatever you look at, and by the way, let's not forget here the Russell. You remember that
Yeah.
that people were like, extremely bullish. The Russell.
You
They were
called the
like,
top up there, buddy.
not, it's not
Within
that I
a
called it.
point. Well,
It's
you
not
did.
that
It
it's
went to
not
your
that I
number.
called it. That's okay. Let's call that lucky that I called the top. If you remember, what's more important is that a few weeks ago I had called that, whoever is feeding the stories that the trade war is bullish for the Russell, and don't worry because during the trade war the Russell should be like overperforming everything, and
Yeah.
the Russell 2000, since it's the vast majority of them are local stocks that they don't have like income from abroad, etc. It shouldn't be affected by anything else that's happening. I said immediately that whoever is saying that, that's BS. I mean, that's BS. And there were a lot of people that were actually buying into that story, and they were being extremely long the Russell, obviously as it usually happens at the worst possible point in the market, right? So the Russell not only did it break down from an ascending channel that dates back to the beginning of 2016, is that it did so in an impulsive manner. It came back, it retested it, and to me, you can see multiple interpretations here, and one of them looks very, very bad because it's not a beautiful one, but you can even see this as a head and shoulders formation, right? So this is one interpretation, a head and shoulders formation. But even if this is not a head and shoulders formation, this is like a descending triangle, and I expect that the Russell is going to be resolved to the downside as well. So you want to see that as a head and shoulders pattern, or you want to see it like as a descending triangle. In both cases, we should see a continuation lower. The only difference being that if this is a head and shoulders formation, the potential target is a lot lower. So, any way you look at it, it's not looking pretty. That's the only sure thing. And as I said, semantics are quite important for the market. And what do we know? We know that, if you asked people a couple of weeks ago, what's going to happen if the Fed turns dovish and Trump with Z seem to come closer to getting an agreement? Everybody would be like, okay, the correction would be over, and indices would be rallying. But what did we end up having? We ended up having an acceleration to the downside. So it's important because we know very well that one of the characteristics of a bull market is that it rallies on any kind of news, and one characteristic of a bear market is that it sells off on any kind of news, right? So in the short term, we have a market that is behaving like a bear market. I'm not going to jump the gun. I'm not going to say that we've seen the top. We might have. I'm not going to say that, but I'm going to say that for the time being, we have a market that's acting as a bear market. So that tells me that at the very least, even if this is a corrective move lower, it's not over yet. Okay, I have been saying that for a long time. I'll even remind you, and I have the file here. Where is it? Yeah, here it is. The SPX fractal. We were talking about it with Joe before he went live on Bloomberg the last time, and I see that this file is made 2 in the morning, Wednesday, 7th of November. So I was giving him my point of view, and this is what I built back then. Is I told him that he intended to speak about the SPX as well. So I told him that in my opinion, the most bullish case scenario here is more or less a repetition of what we had back there. So quite a choppy range that's going to have some recoveries that might look strong, but we're also going to have some sell-offs that are going to be strong. So this is the most bullish case scenario, and we are still. It's been a month since then, and we're still playing out this scenario. I mean, there is still the possibility that we're just going to end up pushing higher from here. But if you're asking me now that we have more price action, what I think is that the most bullish case scenario, which is that is not going to play out. I think that the most bullish case scenario that I see as likely now is another push lower for at least like an ABC, B being a triangle or whatever, in which case I would be targeting lower levels. So for example, 2480, 2560 at the very least. So I think we're headed lower from here, even if this proves to be part of a corrective move. Now, you asked about what's happening here with emerging markets, China, etc. Depends how you draw the line. We had a little false break higher here in the China large caps, and having to do with emerging markets. Is there a possibility that we also had a false break higher? We'll see. We'll find out today, because we broke higher and we came down, and we're testing this horizontal support resistance area. So let's see what happens from here. To be fair, if you remember, I said that my long-term view is perhaps for an overperformance in emerging markets, and lately they have been overperforming the S&P. There's no question about it. But keep in mind that in the long term, my bias for saying that I believe that in the longer term, the emerging markets are going to overperform is the fact that I believe that sooner or later, the dollar is going to have a very, very bad breakdown. And when I say sooner or later, that doesn't mean it's going to happen this week, because from a technical perspective, the dollar is still holding up quite nicely. So I have absolutely no reason, to be looking for the dollar to get decimated, right? The dollar is barely still holding this ascending channel, but even if it breaks lower, this is not yet an indication that the dollar is going to break down, and collapse. But I do believe.
Could I ask you a question, Steve, on the dollar? I don't know.
As many as you like, Coach.
Okay, we're kind of moving sideways. What's this, a daily? I don't know, maybe move to a
daily.
4 hour.
This is a daily, yes.
Maybe move to a 4 hour or 1 hour. I know you don't look at 1 hour, but maybe 1 hour on the 4 hour on the dollar.
4 hour, dollar 4 hour.
Oh, okay. So couldn't this be like a 4, like a triangle? And if we get a breakout, one more thrust to the upside, it would be terminal. That would be the fifth wave terminal thrust up there.
No, it can't be. This can be part of an irregular correction, and I'll tell you why. Because this, very clearly, and you can see it yourself, this is not a 5-wave move up any way you slice it.
Well,
why?
right. Oh,
because it invalidates all the rules of Elliott waves having to do with 5-wave moves. Because if this was to be a 5-wave move, then
it wouldn't overlap.
Yeah, it wouldn't overlap that much. You know what I mean? You need to have a very So I think that if this is something, this is the end of an impulsive move higher, and this is perhaps like an A, C,
irregular B. Okay.
Exactly. So an expanded flat. That's the most bullish interpretation, is this being an expanded flat, which might have one more leg lower, trap people short in the in the worst possible. Except if it proves to be a running flat, the difference of a running flat is that C doesn't actually make it below the previous low. So it might stop somewhere here and then move higher. So this is not a 5-wave move higher. This is something different. That's why I think that even if it pushes a little bit higher, I think that this move is not impulsive, and I think that the dollar is going to move lower. Now, the $1 million question here, yeah, okay. There is let's say from a basic technical analysis perspective, just by looking at momentum, and I saw that, and I know that Blake was talking about the same thing yesterday, that there is a clear loss of momentum. We can see it also in the RSI here. And from an Elliott wave perspective, we agree that some kind of a move lower is coming in the dollar. Now, what we're not certain yet is what kind of a move is that going to be. Is it going to be a corrective move, and we're going to have more upside, or is it going to be some kind of a significant top that we're going to form here and then move lower? I can't answer that yet, because the markets are quite unpredictable. So I want to make that clear. When I say that I'm very bearish the dollar, I'm talking about an horizon that might be a few months out, even a year out. But I think that within like a year or whatever, the dollar is going to find like a major top. It might happen a lot sooner. It's going to find a major top and aggressively sell off lower. And when that happens, I'm going to be very, very, very hardcore short the dollar against a lot of currencies. And I'm since that's going to align with my fundamental thesis, I'm going to be holding on, and I'm going to be having long-term targets for that move. Now, something else I wanted to show, since we were speaking about equities, is the VIX. So the VIX today is testing resistance. By the way, this is a parallel trend line to this trend line that we broke out. So it's also quite interesting to see what the VIX is going to do from here, because the VIX is now on resistance. I think that if we break this resistance on the VIX, I think that at the same time we're going to be breaking down in the S&P from this triangle, and that's going to more or less solidify that what we've seen already happen in the DAX, which is a push lower from this consolidation, what's already happened in the FTSE today, which is a breakdown from this triangle, with a little bit of a delay we're going to see from the US indices as well. So I would be extremely careful in trying to buy this market, extremely careful. As Blake said, from a risk reward perspective, you can buy it here, and you're going to know when you're wrong. I mean, you can have a tight stop loss and wish for the best. But personally, I think that the chances that we're breaking down are, quite a lot higher than 50%. Okay, so that's what I think about that. Now, having to do with, let me see if we have any questions. It can be an ending diagonal. That's
For the dollar.
That's correct. Yeah, you're absolutely right. There is no disagreement with that. Kerem is saying, CME says intervened with 10-second pauses to prevent harder fall in equity futures today. Okay, that's interesting. Any idea why the markets have pushed so far down? Actually, if you're asking me, I can tell you that I have no clue why the markets have pushed that much higher. I'm kidding. I know why they have, but fundamentally speaking, this uptrend makes no sense. I mean, even where we currently are, fundamentally, we're extremely, extremely overbought and extremely overvalued. So I think that it's worth having a top-down view in things, and keep in mind that when you're talking about like a big sell-off, you can just zoom out on a weekly chart and put things in context, because does this look to you like a big sell-off? Because if this here is a big sell-off, what is this? Right?
Yeah, and put it in perspective. The S&P was expensive at 1,500 in 2000 and 2007.
Yeah.
Right?
Yeah.
So, I mean, if you put it in perspective, it's barely a correction.
Yeah, it's barely a correction. Exactly.
Yeah.
Exactly. It's barely a correction. So trust me, when this market finds a top, if it hasn't done already, the kind of a move we've seen already to the downside is going to look like a walk in the park. That's the only certain thing I can guarantee you. Yeah,
Peter,
uptrend is because of free money. There's no question about that. Yeah. Oh, sorry, I didn't even realize that.
That's okay. Peter just got here, so perfect timing, okay. Steve. And thanks for letting me interrupt you again today.
No, it's always my pleasure.
Multiple times.
I like a vivid live conversation. That's why I like, I interrupt people often because I want the conversation to move.
Yeah, you and I just did it again. You and I have that in common.
Yeah, and I have no problem being interrupted. If you want to ask something that's going to move the conversation forward, feel free to do so.
Okay, brother. My trading warrior brother, Steve Bolge, thank you very much. And Stelios, my trading sappy warrior brother, thank you very much. And Blake and Peter, I see you in the house. What a great day to have a bear as my guest. And I'm now going to make you the presenter. and really looking forward to talking to you, Peter. I follow your work. I get your emails. You know,
good.
we're going to try not to scare people too badly. You know, I said, you know,
I better
how are
not.
you?
I better shut up then.
Yeah, I know. How are you, buddy?
I'm good.
All right.
Good. How
So
are you? You're obviously
good. So it's great to have you back, Peter. You know, I follow your stuff. I get your emails every week, and you know, follow your ideas and your commentary and your macro stuff. But you know, I said today, is it better to be prepared even if it makes you scared? And I think it is. It's hard to have you know, your head in the sand like an ostrich once you know. And I exchanged emails with you yesterday and said you know, our wheelhouse is currencies. So you're going to talk to us a little bit about the dollar. And Peter is really an interesting guy to follow because he's read all the masters. Peter even flies to New York to go read manuscripts of who? Dewey?
No, that's Dr. Wheeler.
Wheeler.
Yeah,
Okay.
yeah.
All right. So he's definitely a student of the masters, esoteric, and integrates it into his work. So really a pleasure to have you back, Peter. I'm curious. So we're looking at the dollar here, and you have that high that we had in 217 as a 5. So where do you think we're at in the dollar?
Well, the dollar is really interesting. When you asked me that, I kind of went, oh God, not the dollar, because the dollar well, everything is corrective in both directions, and that's the problem with the dollar. All of the, you know, we're talking Elliott wave. I'm an Elliott wave guy,
right?
And so
I heard that from an Elliottian today. He said because of currency wars, there really aren't a lot of impulsive moves that, you know, up and down are mainly corrective. And you're confirming that.
Yeah, everything is corrective. And the other thing, you know, we talk about U.S. indices, and you said, well, stick with Forex, and I may as well be doing the U.S. indices because they're all moving in lockstep. Everything is moving in lockstep now towards the final end of this thing. And it's really, I said it was going to happen 3 years ago. In fact, Prechter, one of the things he said, which has been correct, was he called it all the same market. And he said they're going to be, everything's going to be moving in the same direction, and they all are. So getting back to the dollar, because it's interesting, everything's going to go up today. You know, Canadian dollar, I spend my time with the US dollar indices, or sorry, currency pairs rather. So there's 5 of them that I cover, the yen, CAD, Australian dollar, and I can go into any of those. I've got charts here for those as well. But the dollar, this could be many things. So here's the wave that we're in right now, this little B wave. I think this is corrective as well. I'm waiting to see what the ending is here, and I've got another chart of this, which is is it a daily? Yeah, it's a daily, which we can go into this final wave. But the bigger picture,
because I saw off an email, I saw off on your emails, you had mentioned UUP, which is a proxy for the dollar, the ETF, that it still needed one more. It didn't look complete up there, and still needed one more high.
Well, it's wandering around, and you can see it in this as well. So what I was going to say about this larger picture here is there are 5 waves to the upside. These are not impulsive waves. So this could be the first part of a zigzag. So you could end up with this wave retracing back down to the A wave, or even partially, depending on what happens here at the top, and then getting another 5 waver to the upside, which might end up right up here at 120 on the dollar. And then I would expect it to retrace. So this says a lot about where we're going. I would say deflation on the upside, and then you wonder, because we know the reserve currency isn't going to be around all that much longer. There's a lot of noise that way, and
so a lot of de-dollarization talk out of our friends in China and Russia and everywhere else.
So that means it's kind of the end of the empire, and I've known that for quite some time. So that's what this is telling me from a technical perspective. I don't think this is coming down right now past this, because the U.S. market and gold are telling me that we're going into deflation. And so that means this is going, the reserve currency should go up in value. And so that's what I'm seeing. But right now, going to this daily chart here and just showing this wave up, I'm showing this, I put little stars here because these are three waivers. So if you want to look at this and say, gee, that looks impulsive, I'm going, well, you know, there's a three waiver, there's a three waiver, there's a three waiver. So impulsive waves, it's funny, I get a lot of my clients that call things impulsive all the time, and I'm going, well, no, all the subwaves have to be in fives as well, and this just isn't. So this looks to me like it is corrective, and if it's corrective, it's going to fully retrace. I just want to see what happens here. There's an overlap here, as you can see, where if this is the actual five waiver to the top, the fourth wave is overlapping with the second wave here, or the first wave rather. And that means that this is corrective. So there's a lot of things telling me it's corrective. You always have
I have a joke for you, Peter. You know why R.N. Elliott was waving at people? Because he was impulsive. But it's okay. His wife was corrective.
Okay, that'd be like oil and water, wouldn't it? Sort of.
All right. So all one market. So if we do get some type of high here in the dollar and we sell off, but you know, we hold the lows, maybe it pulls back to 94, 92, would that be relief for equities? Because I think, you know, you called this decline this week in S&Ps, although, you know, I don't know if you thought you'd have that kind of reaction Monday to the G20, but it you know, I was surprised it didn't even take the stops out over, you know, 28.13. So I know that even you, who's long-term bearish, have a glimmer of hope for people that did not raise cash earlier, that there still could be one more high after we finish this off.
Yeah, there is. Here's ES, the daily on the E-mini futures for the S&P 500. So this I just pulled off before we get on. We're going up today. This is one wild market, and
I've never seen anything like it.
Yeah, it's really pretty amazing. So, you know, if you look at, I don't know if everybody's used to the big picture here, but this was I've got it as a running flat. So here's the top of the third wave in the S&P. And this entire structure from 2009 is corrective. We're not supposed to have B waves at the top of a market, but we have a B wave at the top of the market. And I think that's because I refer to it as an unnatural wave. It is central bankers creating more debt than we've ever had in our lives.
Okay.
Like anybody, you know, so that's
very managed markets. Central planners affect even Elliott wave.
Yes, they do. But the other thing is that the NASDAQ side is impulsive. So the NASDAQ waves are impulsive, which is really what is fueling this market. Well, we know that by the things. But that's an impulsive set of waves, and so you can really see the difference. And that's why in the S&P 500 we have this humongous fourth wave, which is bigger than it should be. That really says, you know, corrective. But this is a running flat. It had a little five waiver here, and you always get in a running flat a 3 to the downside, which is what we had here. Then you get a 3 on the upside, and then you get a 5 waiver, which does not go to a new low. So that's a flat, running flat. And and so then we had a little 3 waiver up, and then we had, this was really interesting, Dale. We had a zigzag to the downside, and right at the bottom of that zigzag, and this was on the Thanksgiving weekend, the Friday, we got another little wave down, and I went, uh-oh, that just screwed up this entire thing down. It made it a 3 because we had one extra wave. I can show you that. Yeah, I can show you that.
I believe you.
And then we went up in 5 waves here, but we did not make the high. We didn't make the previous high at 28.20.
Yeah, I was shocked because, you know, I believe in stop hunts. I can't believe they didn't go for the stops over there.
Well, we're going to make it. We're going to make it now. So we had this wave down here, and then we finished last night. We had that little announcement in Vancouver of that Chinese lady getting locked up, and so now we have major trade wars, and we had another dump here. If I go to the 60-minute chart, here's where you can see in ES, here's where you can see that wave that was that rogue wave that came down to a new low, because we had a zigzag down here, and then we had one extra wave, which made the whole thing corrective. Then we got a wave up to almost to 2820. Now we've got a wave down here, and this wave, as of this morning, here's this morning, we got a double bottom pretty well, not quite, but it's going to come down at the open. And this is a corrective wave to the downside. So it's interesting where it stopped, because now the A wave, the same length as the C wave, will take us to 2840. And I had that as another possible. It's funny how Elliott wave, how this market moves.
What a great day to have you at a possible turning point for
turning. Well, every day is.
Yeah. How do you position? You know, that's a great. You know, I'm glad we touched on this. You know, I was playing bearish ETFs for a while up near the highs and everything, but I just have a hard time in a market like this holding a position. I don't know how you do it. You have to have ice water running through your veins, because or just walk away from the screen. Don't you think it's been very difficult to hold the position in it?
It's very difficult. You have to be watching. Well, I mean, here we've got another turn after 3 days. So this will probably take us through, I would think, Monday, because it won't come down, as we know, on the weekend. But it will probably take us through Monday. And then we're going to come down. And Dale, this is the big one. I was going to say, this is going to scare. I've been saying now, and you've been reading my stuff, I've been saying, where's the fear? I want to see fear in this wave. So this wave is going to set up at about, this is an old number, 2840, I think we're going to top. And then we're going to come down in this final wave of the fourth wave, which is going to take us down below 2400. And I think
clean out the February lows of early in the year.
That's right. And it's got to do that, because all of my Fibonacci extensions just sort of say we got to be under 2400. And that'll give us a fear, and that'll finally give us a fifth wave to a new high, because this is a fourth wave, and both the S&P and the NASDAQ have to do a wave to a new high, and that would finish off the market. But it's going to be barely a new high, because this is a corrective wave.
Okay, not 3,200, so like some Elliotticians are saying.
Well, you could. I've got sort of 3,000 as the top, somewhere in there. I don't think it's going to get to 3,200. I'd be really surprised. But
I know you do time stuff too, Peter. Is kind of the timing for the spring when the truce is over with China on the trade war?
I don't know. Well, Elliott Wave doesn't do time.
Yeah, that's right.
It's terrible. But I've got a guy, Andy Pancioli, who I follow, who I use his cycle turns.
Right.
And so that gives me a sense of timing. I think we are going to come. I think this is going to bottom before Christmas down in here. That's how fast this wave is going to come down, I think. As you can see what happened here. I mean, this was a big drop.
And Mr. Market is going to make people sad before Christmas and panicked before Christmas, and not go to Target and Walmart because of that on Christmas.
Yeah, I think we're going to. It's going to. Retailers are going to be very unhappy this Christmas. You know, we can already start to see that. So this world is really falling apart pretty quickly. I mean, you know, I've been predicting this for a long time, and sure enough, this is what's happening. It's really pretty amazing to see.
So people are looking for cover long term. You're a deflationist, so could I assume that this rally we're getting in gold that looks like, you know, short term it's about to break out right here, that it could just be a rally back to say 1280 or something like that and then fail again?
Yeah, gold is sorry, let me just find it here. Yeah, it's going to fail again. Gold, this is the daily chart on gold. So this is showing you the wave that we're in. This is a corrective wave to the upside here that we're in. And oh, the Forex looks like got these things working again today. That would be nice. They had PC 2000 has been out for like 3 days on the Forex feed. And that, oh no, this is gold. Sorry, I have my gold Forex here. No, it's not fixed. But this is the gold daily. So here is this is a corrective wave. I'm expecting a spike. I put a couple of, for my Fibonacci thing yesterday, I put a couple of possible levels here for this spike. And then it's got to come down though and do a bottom at the bottom here at either 1122, 24, somewhere in there, or around 1,000, and then it will turn around. The bigger picture, if you want a quick little shot of this here, that's a better chart. So this one is a weekly going back to, here's our top 2012, just to set this up. 5 waves down is our A wave here.
Got it.
And then we're in a B wave, which eventually will get up to about 1585. And I would say once the market tops, I think we're down at either 1122 or down here at a double bottom at the top of the US indices, which will be, beginning of the year, February maybe. And then we're going to spike up as the US market comes down, but then we have another C wave, which will take us down to about 700 eventually. So that's our deflation kicking in.
Oh, wow. Okay, man. All right. So, so there are lots of trading opportunities before things really fall apart here. And in gold and dollar and the S&Ps and
the Forex. You look at, I've been looking at this one for the longest time, which is a US dollar yen. The weekly on that. And this one is just, it's in a little ending diagonal right now. My target is about 116, and then it should turn down and go to about 94.95, down to this 62% retrace level, which is about 94.95. So this will turn from about here, and that should be the 5th wave in the US indices. So all of these reversing, all of these currencies, you name it, all the US dollar currencies are going to reverse at the same time and do the 5th wave to a new high in the US indices, and they're all going to have large waves. The euro as well will go to a new high because it looks corrective on the wave down, and the Australian dollar, which is another interesting, a great trade there, will also go to a new high.
New high over parity?
A new high, where am I at here? Here's that's
so you've already declared about him in Aussie. So
declared about him? What do you mean?
Well, about him, you.
Declared about him. No, I haven't. No, we've got a bottom still to go here. This wave turned out to be corrective. It looked good. It had a wave up that was in 5 waves, and then it went and did a 7th wave.
Okay.
And I was saying, I think it's corrective, and sure enough, then it went and did a 7th wave and proved it. I'm looking at a new low and then up.
Okay. Well, looking at your stuff, to me, it implies that there's one more push up in the dollar, and maybe that's where equities go down to flush out all the lows, and then the dollar turns down and equities turn up for wave 5. Because you talk about that Proctor all one market. Am I reading your work correctly?
Yeah, that's what I'm expecting.
Okay.
And I've been expecting that for a long time, like years, 2 or 3 years, and it's all kind of fallen into place. So, yep.
A lot of people are picking up on what you talked about a long time ago, the cooling cycle, while we're talking about, and I have a question for you. If you believe in the cooling cycle, why are you in Canada? Why are you at the equator?
It's why am I in Calgary where it's 7 o'clock in the morning?
Yeah. Oh, we have the same hours. 6:30. Yeah, 6:20.
I'm trading market in Calgary. My goodness, I don't get any sleep.
I know we got to go to another time zone, buddy.
Yeah, if you believe Wheeler and the work that he's done, and now we're getting all these scientists coming out and saying, we're going into a Maunder minimum. We're really going into a dark ages, and that's what I keep saying. Historically, after this high, it's going to get colder and drier. You're seeing the forest fires. That's the dryness. It's going to get a lot worse. And it's interesting that Wheeler said that there's the band between sort of the 48th parallel and Mexico, which is what the U.S. is in, which is closest to the sun, which gets the extreme climate. And in like this week, you're getting all kinds of wild stuff going on down there with all this snow, and we don't get any of that up here. We're not getting any of that. We're above 0 for the next week, which is good. We haven't had our typical 20 below 2 weeks before Christmas yet, and it doesn't look like we're going to get it.
That's
so it's
weird.
a lot it's milder here. You're closer to the sun. We're on a cusp right now where we're going from warm and wet, which we've had, well, sort of warm and dry the last sort of decade, and it's now turning colder and drier. So it's like going from fall into winter. And so what do you get when summer into winter? So what do you get in the fall? You get extreme climate. You get storms and all kinds of things. Put that on a 25-year scale, which is what we've had since 1998, which is where we had the turn. And so we've gone sideways in terms of temperature, and we're now starting to head down. And if you actually look at the temperature graphs, you'll find that in 2007, it was really cold that year. 2008 was a really cold year. It was in 1929 as well. It was in the 1970s, which was the major recession. Whenever it gets cold and dry, the markets come down, which I think is fascinating.
You know, Peter, fascinating interview with some great counts. I want to thank you for being generous with your long-term outlooks, because, you know, it's there on video, and people are going to be able to refer to this for a long time. Why don't you show your website now so that people could follow you more closely and keep an eye on current developments and what you're looking for down the road, how they could immerse themselves in your work?
Here is my website here, Science of Prediction Through Cycles, and I've got some interviews on it. So it's got a lot of the major articles and videos and things there. And then you go to the market forecast, and I do a free blog every weekend. This one's on hopium.
Yeah.
That sure proved to be the case the week that I did it, which is what I was expecting. But this I put in, there's my long term.
You have some of those, I don't know, Percocets or something falling out of a bottle.
Yeah, that's the hopium. Yeah, it feels good until it wears off.
Right.
which is exactly what happened.
When do you do your chart show? On the weekends?
I do it on a Wednesday at 5 o'clock EST. Yeah.
Okay.
EST.
Okay.
Yeah.
Well, Peter, I hope you have a Merry Christmas and Happy New Year. And
you too.
I really want to thank you for coming back, and I hope we didn't scare people too much, because I consider your work, you're like a watchman in the markets for me, my trading warrior brother, and appreciate your hard work.
I spend way too much time at this. This has been an incredible journey. The last year, I had no idea we were going to go sideways like this. We've stayed on top of it, but boy, it's tough. It's a tough market.
It's a young man's game. What are we doing, Peter?
We're stupid. The scary thing is it will pay off next year, and it'll all be worth it next year. So all
right, well, we're going to have you back, buddy, and I really appreciate you being with us, my trading warrior brother.
Well, keep up
the great work, Peter, and again, may pips rain down on you during warm cycles and cold cycles. How about that?
Thank you.
All
and,
right.
and you have a great Christmas and a great holiday. Thanks again.
Okay.
Dale. I really appreciate it.
You're very welcome, everyone. That's Peter Temple. I told you that you bulls that don't lose heart. There could be another rally for In fact, having Peter on today, there might be a good shorting opportunity coming up within days. So thank you, everyone. Have a great day. And remember, most of all, in these times and in all times, don't just count your pips, count your blessings. And we'll see you for the NFP tomorrow morning. Adios. Thank you, Peter.
Hey, thank you, Dale. Okay.
All right.